In New York City, I'm Julie Hyman, that's Josh Lipton, this is Yahoo Finance Live, and here's what we're watching this afternoon. Investors taking another breather, the Dow off more than 100 points heading into the closing bell on Wall Street. The Nasdaq and S&P 500 are fighting to hold on to slim gains, and markets wait for key inflation data on Thursday.
And Citigroup getting a vote of confidence from one Wall Street analyst, raising the stock to a buy. The analyst behind that call joins us later this hour to weigh in on the deep cost-cutting efforts from CEO Jane Fraser and what the bank's newest hire means for its business ahead.
And Apple reportedly pumping the brakes on its plans to build a car after a decade. Our own Rick Newman said way back in 2015 that an Apple car would never roll off the assembly line. He'll weigh in on this new report later this hour. Let's get you up to speed on the market action. As we mentioned here, seeing kind of a mixed picture on the day with the Dow trading lower, the S&P 500 and the Nasdaq, though, gaining a little bit of steam here today. We've got utilities that are doing the best in today's session. They were the big losers yesterday. Ditto communication services, which also were pulling back yesterday and are coming back here today. So that's what we've got on the upside in today's session. Interesting to see utilities rebound even as yields continue to move higher today. And then we've got energy stocks that are down the most in today's session. But there's a lot of activity under the surface and perhaps outside of those major averages. So let's talk about that, because we've got, as one example, Bitcoin rocketing higher again today, pushing past 57,000. And, you know, we talked a little bit yesterday to Ryan Rasmussen over at Bitwise about what could be going on here. And he brought up the reasons that a lot of people brought up. He talked about the upcoming Bitcoin halving. He said that, you know, the spot Bitcoin ETF rollout possibly helping out matters. Ethereum, which has been moving up higher, also maybe benefiting from speculation about a spot product there. But there also is the idea that came back into my head as I was looking at this action. Prices go up because they go up. In other words, to borrow the meme and also the title of Zeke Fox's book, Number Go Up, which is one of the memes associated with Bitcoin, this sort of cyclical that people want to buy because they believe the price will continue to move higher. FOMO trade, I guess, is another way you could put it. What's been interesting to me is it's not just happening with Bitcoin. If you look at our trending ticker page on any given day recently, you've got a lot of AI-related stocks, but also other types of just sort of speculative plays that have been seeing big gains.
Well, first of all, I'm glad you brought up the fundamental reasons why Bitcoin could be moving higher, or Bitcoin bulls would be blowing us up on X, which is a good call on your part. So, you know, I also just wondered, Julie, if I look at kind of the general investing environment right now, whether some of this is explained by investors kind of just feel good generally about where we're at. You know, it's not too hot. It's not too cold. In other words, kind of Goldilocks feel. The economy's growing. Inflation is cooling. You know, Fed cuts on the way, so we think. And they just feel kind of positive and constructive.
Listen, just to go back to one thing you said, if Bitcoin bulls think the only reason that Bitcoin is going up are for these so-called fundamental reasons, they're delusional, and they can feel free to tweet at me all that they like.
I'm just glad we're covering our bases.
I mean, listen, we know that it's a speculative asset and that people buy it because they want to make more money. And I think also, even though I like to push back against the narrative that the market is a casino, it was interesting that Warren Buffett in his note said the market has become more casino-like over time, and that there is this aspect of people wanting to strike it rich in this market. So that's why something like Viking Therapeutics, which we're going to talk about more later today, is more than doubling today because people think that it's going to be the hot next thing potentially in weight loss. I mean, that 129% gain.
Because if there's any other theme besides AI that we talk to, it's probably weight loss drugs.
But the interesting thing also is even things that have nothing to do with any of that. Our Norwegian Cruise Line, again, we're going to talk about it later, it's up 19% today. It's a cruise line operator. It has nothing to do with AI, nothing to do with GLP-1s. You know, Plug Power is up 18%. Hims and Hers is up 32%. And it's not exactly a meme stock thing, although maybe it's another flavor of that. But again, maybe just people are feeling good. Maybe there's short interest on some of these. Maybe options, you know, activity is driving some of it. But it just, it just feels like there are a lot of big speculative moves that are happening in the market right now.
I do wonder whether the PCE print on Thursday, what kind of impact that could have. Because when we did have, it is just interesting. I know it feels like so long ago, but you had that higher than expected CPI print, and the market reacted violently to that, right? Red everywhere. And I think that shook a lot of people's narratives up. But then NVIDIA came in and report and beat and surged and dragged everything up with it. So I'm curious what happens on Thursday.
I mean, and that PCE report shook people for like a hot second.
Sure.
The market, even before NVIDIA really started to recover, maybe it's just those general good vibes that cannot be kept down for some reason.
All right, so thankfully we do have some smart market strategists we can ask
People
about
don't
this.
just have to rely on us.
Exactly, right. So for a closer look at how to play or avoid this momentum trade, joining us now is Dory Wiley, Commerce Street Capital President. Dory, it is good to see you. I don't know if you were listening, Dory, to this conversation I was having with Julie here. We were just kind of talking about the kind of broader investing environment we find ourselves here in Dory. We look at these moves, NVIDIA, the broader kind of AI mania we're seeing, and of course Bitcoin rallying, and just I would love, Dory, just to get your take on what do you make of some of these moves? What do you make about the environment we find ourselves in?
Well, good beyond, and I was enjoying the conversation because I think we have a new mental mindset today that we haven't had for a while. Previously, recommending making sure you're allocated to the big seven or magnificent seven, ex Tesla, overweight NVIDIA. That's been working for us as a money manager. But now today, which is the conversation you have, we know there's euphoria in NVIDIA, right? We don't know how much, but there's a core reason to own NVIDIA. It supplies all this AI to everyone. It makes money. It coins money. It has a massive margin, and everything's at light speed with accelerated computing and what they're doing in AI. And they're touching all the other Mag 7s. So, but there's something different today. Just something different. Bitcoin, that's a euphoria measure. Some of these other stocks, I was looking up SoundHound today. It's got a great technology and voice AI, but when you look at it, it's got a market cap of 1.8 billion, and it has 34 million in revenues. Well, immediately when you look at that, my mind goes back. This is .com-ish. I remember these kind of numbers in .com. How can I have a 1.8 billion market cap on 34 million of revenues? That's more euphoria than we have in fundamentals. Doesn't mean they don't have a great product, doesn't mean they don't have a great future, but surely that's a little ahead of itself. Doesn't even make money yet. And neither does another one, Bear AI, the same thing. Great product, great job in AI with logistics and with supply chains, getting themselves into the market, getting entrenched. But again, they don't have the revenues. They have a $525 million market cap with revenues of $154 million. Not as bad as SoundHound, but still ahead of itself. And we're seeing this in the market today, a little more euphoria. And so the question I had for myself today was, is this the beginning of euphoria? Because I was okay with this tech rally because there were fundamental reasons for it. But now it's starting to feel euphoric. And how long can that go? If you remember, the Irrational Exuberance speech started in February of '96, and it took 4 years to pop the bubble.
I mean, it feels like it's been going here for a little while now, Dory, right? Certainly not 4 years, but call it maybe 6 months. Maybe you can even date it back to when NVIDIA first shocked the market last spring with its forecast. So I guess the question is, in this kind of a market, do you try and chase or participate or risk leaving out, not participating in the upside for some of these? Or how do you kind of play it in a smart way?
So what we've been doing is I think you under allocate Mag 7 or Mag 6, ex Tesla, because I can find fundamental reasons not to do that at your own risk and very risk. I think you got to stay allocated, and I think you have to tilt to some of your favorites like NVIDIA, and that's been working. But it's because there's fundamental reasons to do so. Microsoft, NVIDIA, massive margins, massive market entrenchment, and great, return on equity. Estimated earnings, estimated revenues continue expanding. You saw for NVIDIA what they did with their net income is up almost 586%. I mean, what kind of company gets you that? A company like that warrants a euphoria. So I'm okay with that. So I think you got to stay allocated there. And if it drops 20%, hallelujah. It'll shake off some of the euphoria and you still got a really good company. I kind of hope that happens. I told my trader the other day, buy on the dips on NVIDIA, and he goes, there are no dips. No, I said, no, a dip is when it goes up only 2% that day.
And Dory, I also wanted to get your take on, a big piece of economic data we're still waiting for, Dory. PCE on Thursday. We know that, of course, is Jay Powell's preferred inflation gauge. What are you looking for there, Dory, and how important do you think that is going to be for the market?
If it's a real material change, that'll be real important. I'm talking about to the downside or the upside. I know this, if you listen to Powell and Mickey Bowman, who I got a chance to interview the other day, and some others, they're very skeptical about the inflation data. They're very skeptical about the unemployment data. So I don't think you'll see them knee-jerk anything right now and changing their statements from beyond, a possible rate cut in May, more likely later in the year as some of the Fed speak that's come out this week. I don't expect that to deviate a whole lot. And if the number is pretty close to expected, then nothing changes.
And sort of what's the feeling, the consensus has seemed to come around to that the economy is going to be pretty good this year, that we're going to see pretty strong GDP growth, especially relative to what expectations were. Is that how you're viewing this as well? And then again, how does that feed through to the market?
I think we have to balance that with the market expectations. Absolutely. So the market is trying to balance this AI rally, if you will, with the expectation of rate cuts, where I think the market's been making a mistake and has been for the last 20 months now, is we don't have to have rate cuts to do okay. We don't have to have them. So it's almost like weaning the market off the bottle. We pull the bottle away, the market's got to grow up. The economy's going to be fine. Having 5%, 5.25% Fed fund, that's okay. People can handle that. We've had that for years. If you remember 20, 30 years ago, all passbook savings and now accounts all paid 5%. So that is okay. The market can do very well with with rates not cutting at all. We don't have to have the rate cuts. And I think that's where the market's been missing it.
Dory, it is always good to have you on the program. Thank you for your time and insight, sir. Appreciate it.
Thank you.
Now, checking in on some of today's top trending tickers, Macys. Let's start there. Look at that, rising here after the retail giant posted revenue and earnings that were better than the street's expectations. So you look at this print, Julie, Q4 earnings ex some items beats. For the full year, though, actually adjusted earnings forecast was below what the street was looking for. But the big headline here, too, was just Macys kind of shifting up its real estate strategy here, saying it's going to close close to about a third of its namesake U.S. locations.
150 stores.
Yeah.
That's a lot of stores.
Well, and remember how many hundreds of stores they operate. I mean, between Macys and Bloomingdale's and Blue Mercury. So, but it's a big move for the new CEO there, Tony Spring.
Yeah, he's only been there, less than a month here. And the company says it's going to now liberate $600 million to $750 million worth of assets through 2026. So free up some cash here for the company. But if you look at the outlook, as you mentioned, for earnings and for sales, it's still pretty grim. So, you can cut all you want, but at some point, the company is also going to have to see some growth in sales. So analysts are saying here that this is the right thing to do at this point. And also, I guess they're going to focus more on the more luxury side of the business, more Bloomingdale's side of the business. And so we'll see if that starts to bear fruit also. Yeah,
they also remember, of course, too, they're dealing with these activists who have been circling, right? They had the buyout offer from Arkhouse and Brigade, and Macys kind of said no thanks to that. But then you saw Arkhouse kind of nominate directors to the board. So obviously those activists undeterred. The stock is up today. We should mention, though, it has basically gone nowhere this year or over the past 12 months.
Yeah, interesting, even with that activist pressure. Let's talk about Norwegian Cruise Line rising today despite posting a wider than expected profit loss for the fourth quarter. The stock higher on the back of strong guidance for the first quarter and the full year. EBITDA forecast for the first quarter also ahead of estimates here. And, it's not necessarily shocking to see this number better than estimated. We've seen other cruise line operators like Royal Caribbean come out and say bookings have been strong. But some analysts pointing out here, including Patrick Scholes, a Truist, that Norwegian's been less consistent than competitors, so that this is a relief for that reason.
Also dragging peers like Carnival, though, and Royal Caribbean, they were higher in today's trade as well. And to your point, Julie, it is kind of, listen, this has been the headline. Cruises are just operating. They are strong. Royal Caribbean upgraded its outlook last week. We talked about that. And the company, this was also interesting to me, the way that Norwegian was able to kind of keep performing even as it sort of adjusted to geopolitical conflict. We know that it canceled and reroute sort of itineraries to Israel and the Red Sea because of conflict there, but still nailed their numbers, and investors clearly liked what they saw here.
Yeah, definitely.
All right. And finally, how about shares of Viking Therapeutics? Julie, you were mentioning this earlier today, and for good reason. Look at that. After the company reported positive results for its experimental weight loss drug, only up about 130% there, Julie. So, I mean, honestly, besides AI, I can't think of a thing we talk about more than weight loss drugs. And the news here, though, so Viking says, okay, we had this mid-stage trial, Julie, and it suggests, I guess, that the company could have a rival to the weight loss drugs offered from, as you know, Eli Lilly and Novo Nordisk.
Well, and it's the numbers in the study from this Viking experimental drug that patients lost as much as 14.7% of their body weight. This was a weekly shot. Although reportedly Viking is also exploring an oral medication, as are many of these other companies who make the GLP-1s. This is only mid-stage, as you said. So it still has to do late-stage testing. So it's still quite early, but kind of to my point earlier, people see something they think is going to hit, and they are in there like a shot. Every time that we show that stock today, every time I've looked at it today, it's up a little more.
Yeah, it's incredible. And it's not just, you know, when you think about this, it wasn't obviously just the results of this trial. It's also because clearly investors must be betting that this is a takeout now target too for somebody in big pharma. By the way, something you don't see that often is just on the street, everybody on the same side of the boat. 10 buys, 0 holds, 0 sells.
Interesting. Yeah. All right. Well, we're just getting started here on Yahoo Finance Live. Coming up, Citi announcing it's appointing a new banking head, and it's leading to some positive reactions from analysts. We'll speak to one of them about the move on the other side. Plus, Whirlpool hosting an investor day today. Yahoo Finance's Brian Sazzi is going to catch up with the CEO, Mark Bitzer. That is later in the hour. Also, shares of Cava higher after it posted a strong finish to 2023 in its earnings. We're joined by an analyst later to break down the quarter and discuss what is next for the Mediterranean restaurant chain. Stay tuned. We've got more Yahoo Finance coming up. An unusual trend on Wall Street today. The market leaders are in a holding pattern. Jared Blickley is the one who noticed that, and he's here with a closer look. Hey, Jared.
Hey, Julie, this has been a great week for unprofitable companies, especially unprofitable tech. And we see this in the meme stocks. There are a lot of different stories here. Carvana up 17%. That's an earnings story. Didn't disintegrate. Congratulations, Ernie. But then we have Coinbase up 2.5% today. But look at the two-day totals. And that's going to be a theme here. You look at what happened yesterday and combine it with today. It's presenting a compelling picture that some of the fringier parts of the markets that are more susceptible to, I guess, feed into that thirsty cash. That's what I was looking for, Julia. A word from back in the day. Anyway, Coinbase up 20%. Lots of green here. And let me just show you what's been happening in sector land over the last 2 days. You might look at all the red here. Only consumer discretionary and tech just barely in the green. You might look at all this red. These are large cap sectors and conclude markets have been down. That is not the case, because when I take a look at the leaders here, a lot more green than red. And it's not just Bitcoin, although that is taking the #1 spot. We see Bitcoin up about 11-12% over that time. But then you have ARC components, that's disruption, then IPOs, retail, small caps, biotech. Lots of things are stacking up, and you can see some cross-pollination here. Here's the disruption trade, and admittedly there is a bit of red here, but Beam Therapeutics, Intellius Therapeutics, 33%, 18%. I was just taking a look at biotech, and it is only now beginning to break out. I'm looking at the iShares Nasdaq Biotech ETF, and what I like about this chart, there's this long period of consolidation, lots of zigs and zags, but there is a handle formation at the end, much like a cup and handle. Works the same way. So with IBB breaking out here, ought to attract a lot of interest. So the rally for everything we've been talking about, all the attention with NVIDIA. NVIDIA over the last 2 days only up 0.4%. Probably good for a record high today, but nevertheless, I think that the mega caps, their time in the sun has not faded. They'll be back, but we're just seeing a little rotation here, probably healthy rotation, hopefully not too fringy, because we know what happens when those laggards finally pop. Sometimes.
Jared, thank you so much for that. Appreciate it. Citigroup hiring Viswas Raghavan away from JP Morgan as its new head of banking. The move is part of a big corporate restructuring announced after fourth quarter earnings disappointed the street, which included, remember, 20,000 layoffs and a loss of $1.8 billion. The new plan has some analysts upgrading the stock now, including our next guest, Ken Leon, Director of Equity Research at CFRA Research. Ken, always good to see you. So you now officially are bullish on Citi, Ken. Your target goes to 65 on this one. How come, Ken? Why is Citi, in your opinion, a name to own now, Ken, and why now?
You know, it's great to be here. And if you've been covering Citigroup or large bank stocks for over 10 years, you have to say, is this time different with the new management and a transition to a new Citigroup? And also, you know, bank stocks, including Citi, had this amazing move in the fourth quarter. So what we see is execution. The bank is really filling in some important senior management positions. They've given a lot more transparency to the street, you know, as it relates to targets, and also taking some one-time restructuring charges. This bank's going to be more efficient in the second half of this year, and then analysts, including myself, will want to know how does Citi grow with the new design bank in 2025. We think it's going to happen.
And just to dig into that a little bit more, Ken, because, you know, as your peer Mike Mayo said on the call, he was skeptical that, and you've been covering the bank for a long time too, and you know that they have tried this before. Is it Jane Fraser's leadership that is sort of the thing that has made this attempt different?
I think it is, but it's also, you know, Citi was this octopus with very complex, confusing business units. And you were never sure what was Citi at the end of the day. By streamlining into areas like a services segment, such as corporate treasury services, they're #1 in the industry on that, and showing some of the more stable and growing businesses, it gives us confidence that that's a good base. And then, of course, the areas that are more cyclical, as you know, which would be the investment banking. And today's announcement bringing a seasoned executive from JP Morgan Chase, that will be a plus as well. So I think it's going from complexity to simplicity, having more light versus dark in terms of what the company is and showing good targets. We never saw that before. Mike and I worked together back at Lehman Brothers a long time ago. So, Mike's, I think, been actually one of the most biggest challengers for Citi. And of course, I have too.
And Ken, let me ask you how you're thinking about valuation for this name as well. And I ask, I mean, you obviously still think it's attractive, Ken. I guess I'm asking because it's had this nice recent run, up about 40% here, Ken, since early November.
Yeah, I thought about that as well. And in essence, it's, you say, well, should I wait? Maybe the overall market pulls back 10% and you get a better entry price on Citi. But Citi, unlike its peers, which are trading at par or above net tangible book value, today is trading at about a 33% discount. So even with the target that we have of 65 or the consensus at 61, you're talking about an 18 to 20% still discount to a net tangible book value in the 80s.
And also, Ken, I want to ask you about the Raghavan hiring in particular away from JP Morgan, which seems to be a bet on growing maybe the investment banking business. Do you think he's going to be successful in doing that? And how important is that to your thesis?
We do, and I think the management approach that we're seeing here for Citi, but also on JP Morgan announcing unifying different parts of banking, commercial, investment banking, global banking, into one regime. And here we have an executive who's done it with the best bank in the world, which was JP Morgan Chase, which we have a buy. So I think it brings a lot of tenure and great skills and leadership that Citi didn't have before. We also reduced the management layers, so the decision-making around the globe is going to become more effective. And I think we should see this in the company in terms of results, particularly as we go through this year and then next year.
We will be watching those results. Ken Leon, thank you so much. Really appreciate it.
Thank you.
Well, Apple is reportedly ditching its decade-old effort to build an electric vehicle. That's according to Bloomberg. Joining us now, Yahoo Finance's Rick Newman and Dan Howley. Rick, what caught our eye following this story was the fact that you wrote back in 2015 that it would be insane, I believe was your word, to think that we were going to see Apple cars coming off the assembly line. And it took them a while, but you were right. Why did you think it was not going to come to pass? And how does why it actually hasn't come to pass sort of match up with what you expected?
Well, if Apple wants to call me about strategic consulting, I'm willing to take their call. So I'm talking about the complete car. And my point back in 2015, which I think is still completely valid today, is that manufacturing something as complicated as an automobile is just not where Apple needs to go. For two words, profit margin. Apple's profit margin is about 26%. That's mostly, I mean, we know what their devices are, but really that's a lot of intellectual property and a lot of software. That's the business that you want to be in these days. So profit margins for comparison. So Apple's at 26. That's awesome. Tesla is only at 16% profit margin. Toyota, probably the best run car company in the world, is 10% profit margin. Then GM and Ford are in the single digits. And it's just a complicated business. It's a cyclical business. There's a ton that can go wrong. Even Elon Musk at some point during the last decade, when they were struggling just to make a profit, he said, wow, manufacturing is really hard. So it makes a lot of sense for Apple to be involved with the electronics and the software and the brains of automobiles, because there is a lot of money there. I just never thought it fit with their business model at all to roll automobiles off an assembly line.
So I guess, Rick, the next question I have for you then, if it's not going to be cars, what do you think is the big market that Tim Cook moves into that can actually move the needle for a company the size of Apple? Do you think it's Gen AI related products? Do you think is it healthcare? Is it mixed reality with the Vision Pro, or maybe some combination of all of those?
So let's let Dan Howley talk about what they might do outside of the car business. But Apple is not going to abandon the car business. they want to be associated with the car, and there's been this big battle underway for more than a decade among all the automakers and Apple and Google and BlackBerry actually makes software for cars. I mean, there are a lot of companies that make software for cars, and they want that as a business line because of everything people do in their cars and everything people do that is associated with their cars. They want to know where you are. They want to know when you're passing their store. They want to be able to send you coupons somehow because they know that you're driving past a McDonald's or something like that. I mean, I'm sure that market is going to develop. So I think Apple will definitely keep trying to go after that business. I mean, again, those are service businesses. That is not bending metal. I mean, that's what Apple does, and I think that's where Apple wants to stay.
So Dan, in that case then, let's talk about the Gen AI piece, because according to this report, Tim Cook, when he announced it to the workforce that he was going to be winding down the car project, he said some of that's going to be potentially redeployed to Gen AI, but like doing what? Because as we know, Apple has not said a whole heck of a lot about that.
Yeah, so the kind of Gen AI portion of this is kind of strange, right? They've been working on generative AI. They've said in the past, or at least in the most recent earnings call, Tim Cook had specifically said that they're working on generative AI stuff and that they'll have more in the year ahead, that they've been working feverishly on it. They were caught somewhat flat-footed compared to the likes of Google or Microsoft, especially compared to Microsoft, which got on this bandwagon right away. But I think as far as what the capabilities will be or how it might start to, roll out across products from the car side of things, it's hard to tell, especially since, this is a project that's been going on for so long. These people will have to be caught up on what's going on with Gen AI and then start to work into that. It seems like an odd call out. To me, it seems like it's less of, let's get more investment in Gen AI and more, let's save some money on not rolling out a car.
Dan, Rick, thank you for walking us through the news. Appreciate it.
Bye, guys.
And coming up, Whirlpool hosting its Investor Day today, and Yahoo Finance's Brian Sozzi is catched up with the CEO of the home appliance maker, Mark Bitzer. On the other side of the break, don't go anywhere. More Yahoo Finance coming up.
All right, big investor day for Whirlpool down at the New York Stock Exchange. To get right to the man of the hour, Whirlpool Chair and CEO Mark Bitzer. Mark, good to see you in person. It's been years.
Thanks for having me back. It's been a couple of years.
Yeah, absolutely. So what was your big message to investors?
You know, our big message to investors was we're at a critical milestone as a company. We have been on a multi-year business transformation journey where we sold and bought some businesses. And now we're just weeks away from completing our European divestiture, where we basically take our European business and combine it with a Turkish company and own 25%. So it's a critical milestone, and I think it was more than appropriate to kind of update investors about that's the different Whirlpool going forward and what our midterm targets are.
How difficult is it to transform a legacy historic appliance maker? And I think the history of Whirlpool was lost on me a little bit. I went onto your website. I mean, this is an iconic company. I mean, how do you unwind some of these things that may not be working anymore?
Yeah, you know, Brian, first of all, I mean, we have an incredibly strong legacy in history. Our company is 113 years old. Our headquarters, literally a mile away from where the company was founded.
That's wild.
We had only 70 CEOs in our history. So it's a company with a lot of legacy and history, but we all recognize, you know, just because you have a great past doesn't mean you have a great future. And the art in this one is not changing the things which work and change the things which we might need adjustment. I think with what we define as a portfolio transformation, but then also what we call our strategic imperatives, I think we've set the parameters right in terms of where we need more pushes without giving up our great tradition and history. So I think we found a good balance, but you know, this is a highly competitive industry where we're the last American large appliance company. And that was very different when I joined the company. So, but I think we have all the things right to have a great future going forward.
You want to get me excited during the week, Mark, send over a slide deck talking about long-term financial targets. But that's what you did at the New York Stock Exchange today. My interpretation was that the first half of the year, because the housing market is still under pressure because of higher rates, it's going to hold Whirlpool back a little bit. Is that the right assessment and things improve in the back half of the year?
You know, fundamentally, Brian, it's with our business being so overall driven by the North America business, the North America business in turn is strongly driven, we know, by housing and by product introductions. And we can spend later on talking a little bit about product introduction because there's a really good portfolio. But housing is a big factor, okay, and in particular existing home sales. And of course, we all know, you know, last December was a 28-year low of new existing home sales. So of course that creates a little bit of an overhang. But you know, the housing market has been soft for almost 2 decades. So the question is not, does it come around? The question is, when does it come around?
When does it come around?
When does it come around?
Do you need the rate cuts for it to come around?
I think, first of all, the new home starts, they're kind of already recovering. 1.4, 1.46 is getting better. I think we need 1.7, 1.9, I mean, the society. On existing home sales, I think you need probably not just 1 cut, but 2 or 3 cuts. I think you would have to see below 6% mortgage rates on a sustained base to really kind of unfreeze the market. Because again, we sometimes lose perspective of what happened within the course of 24 months. So existing home sales dropped from 6.4 million to 3.8. I mean, I don't think you've ever seen such a kind of drop. So it literally froze. So to fall that, I think it takes more than one interest rate reduction. And you know, that's ultimately, we got to see when and how it will happen. And it's kind of, by definition, we're not, it's more a back-heavy event when it starts moving. And the first half of the year, and we guided towards this morning earnings call, I think will still be a little bit softer. But you know, we know that, we're prepared for that, we have our costs in control, so I think we're in good shape.
Has inflation become less of a problem for Whirlpool?
Well, you know, inflation was a 2 or 3 year massive problem. You know, it's overall it added almost 3 billion, 2.5 billion to our cost base. I mean, these are unheard of numbers.
That's astronomical.
Yeah, that's astronomical. So last year we were able to get 800 million of that out of the way. This year we take another 500 million out, so we're still operating slightly higher than before. And you know, some of inflation, I mean, you have wage inflation, that doesn't go away, it just stays there. I think what we do see is now clearly, I mean, we saw that already last year, moderation of inflation rate, and right now it's flat. But again, that doesn't mean that you get all the costs back to pre-COVID levels. So, but I think we overall, you know, we're now tackling where we can, logistic costs, product costs. We're also, you know, questioning and addressing our overall infrastructure costs. We have a simplified business going forward, and as such, we probably don't need the kind of more or less complicated structure which we had before. So we're addressing the cost on multiple levels. But frankly, the inflation, we're not counting on a big deflation, just a moderation is already fine.
There's been some reporting within the past 2 weeks on appliance quality. I'm sure you saw these stories. Yahoo Finance didn't write this stuff, but nonetheless, I made a note. I'm like, when I talk to Mark, I have to ask about this stuff. Because appliance quality seems to have gotten a bad rap. Maybe companies have taken quality out of their products so they break and you have to replace them. Set the record straight.
Yeah, so I saw the article. It hurt my feelings. I don't think it is a reflection of the actual facts. So let me explain you why. Appliance life is not driven by calendar years. It's driven by usage. It's like a car. I mean, of course, the more miles you put on a car, so it's not driven by years. And what happened, COVID and post-COVID, people are using it much more intensively. I mean, we see that in replacement markets. So yes, people are using it more intensively, and therefore it gets replaced a little bit earlier than may have been in the past. The actual quality data, and we have pretty good data because we see every single warranty call, actually at Whirlpool, I mean, over the last 20 years, every year went down. So we're right now hovering, and that's a more or less non-public number, but we're hovering around a 4% failure rate in first year. So, and that compares to more high single digits a couple of years ago. So we feel very good about quality improvement, in particular in the context of products which got more complicated, have much more technology and electronics in there. So we feel very good about the actual quality rate, but the usage is more intensive. So I think people are confusing two trends here.
And you're also making a big innovation push this year. A lot of focus on small appliances. I think that may have surprised a lot of investors. These are higher margin products?
Yeah, I mean, so small domestic appliances is a business which historically was embedded from the numbers in our regional report. So in some ways you could refer to a hidden gem but it is one of our best businesses. And small domestic appliances, they also, like the majors, live from innovation. So small domestic, of course, in our case, has the strength in its stand mixer of a heritage business. But we know from a consumer perspective, in terms of if you ask consumers what is your most preferred brand on espresso makers, we get a high preference. So
it's Starbucks, Mark.
Yeah, well, so in a certain way, consumers give us license to go in other categories. So that's why we're pushing this year heavily into fully automatic espressos and semi-automatics. But it's not only a small domestic appliance. We have on the majors business, we have massive new launch. We have a new front loader coming. We just launched a Maytag pet launch, dishwasher. So listen, ultimately it comes down to, this is an industry, if you stand still on innovation, that's a bad path. And we kept on investing.
Are you back, when are you back to growth? My sense from the presentation was not until 2026 in the US?
Part of that comes back to what you asked earlier. So the housing will come around. But keep also in mind, even if housing moves, for example, new homes, we're at the tail end of a new home. So a new home gets started, gets built. The appliances are pretty much the last thing before the house is complete. So we, by definition, have a little bit of tail end until we see the full momentum. On the other hand, it's very predictable because we know once a house is being built, at one point the appliances come in. So I think what you see behind this one, from a broader industry, we're kind of conservative, if you want to say so, or moderately conservative, the next 12 to 18 months. But after that, we feel very good.
Of course, we're asking all leaders, we're getting ready to head into election season. Now, I remember talking to you in the past about how Chinese companies were dumping various products on the US, lowering prices, hurting American manufacturers. Has that started to improve? And what policies have lawmakers put in place that have been helping your business?
Yeah, so it's obviously always dangerous if the CEO comments on politics, and I will try to be careful around this one. Listen, ultimately, this is globally a very competitive industry. As I mentioned before, we're the last American large appliance company. Everybody else, there's 2 Europeans left and the rest is Asian. Nothing against Asia, but it's Korean, 1 Japanese and a Chinese company. So we're competing, if you want to say so, as an American company against a lot of foreign competitors. We are all in favor of if it's a level playing field. We have our confidence, we know how to produce, we know how to cost efficiently with innovation to produce. I think where we, in the past, were concerned if people are selling products in the US below their domestic markets and these kind of things. Has it moderated over the last couple of years? A little bit. We're still here and there some categories where we would have some concerns. But at the same time, as a company, we're also particularly focused on input costs. So for example, for us, steel cost is a big deal. And steel cost, if I buy today's steel in the US, it's about twice as expensive as China steel. So fundamental competitiveness of input costs is for us a really big deal.
All right, let's leave it there. I say, Mark, it's always good to see you. You always give us some of the best insight in the game markets. We'll catch up with you soon. Much more ahead on Yahoo Finance. Don't go anywhere.
Shares of Cava soaring in today's trading after posting a strong finish to 2023. The fast casual chain beating estimates on revenue, adjusted earnings per share, and same-store sales expectations. It also issued a stronger than expected annual outlook. Let's bring in John Tower, City Director and Restaurant Analyst, for more on this. What do you think is sort of the primary driver here of this surprise coming from Cava, John?
Yeah, it's strong traffic. I mean, they're executing at the store level. They've got products that consumers like, and they're competing in a category that's effectively where the consumer wants to be with respect to, fast, convenient, reasonable price point, high quality food, and digitally enabled. And I think all of those things are working exceptionally well. You can look at Chipotle as another example. Wingstop, same idea. This fast casual space right now seems to be on fire, and I don't think it's anything relatively new. It just seems to be showing up on the relative results right now within the subcategory. So, and when you think about the brand itself, they are effectively carving out a category of one. When you think about Mediterranean chains across the U.S., there really isn't a large competitor nor any threats of any real competition moving in anytime soon. So they've got quite a bit of runway ahead, and I think they're just effectively capitalizing on it with delivering at the store for the consumer every single day on every transaction.
And John, correct me if I'm wrong, but you're actually neutral on this name, John. So what would you need to see before getting more bullish?
Yeah, look, it's tricky. They've executed really well. They've continued to put up numbers that best expectations. They came out of the gate with a fairly rich multiple, and that's actually expanded. So we've been wrong. And I'd like to get more confidence in the idea that unit growth is going to continue to exceed the numbers that they're putting out there. This year, they're guided 48 to 52. Early evidence suggests that they're probably going to beat that. Certainly, they did it in 2023. Looks like they could probably do it again in 2024. So that's one piece of it. And then the other part is continued upside on the EBITDA front. And, they guided 2024 above the street. It was within our their range was within our estimate. So we didn't necessarily see upside to our numbers coming out of this. So it's really just continuing to execute and deliver, and I just like a better entry in the stock price. That's it. I mean, where it's trading today is it's rich.
I noticed you do have a buy on Chipotle, and I imagine Chipotle is sort of the model for anyone who wants to open a fast casual chain, particularly one like Cava that is effectively Chipotle but for Mediterranean food. So what lessons do you think that Cava could sort of learn from Chipotle and seek to emulate, right? And then to have that sort of sustainable outperformance?
Yeah, I think one of the secrets behind Cava's early success out of the gates and prior to the IPO is the fact that on their board, they have a member in Ron Shaikh who has been helping them avoid many of the missteps that historically fast-growing restaurant concepts kind of run into. And that is typically found in poor real estate selection. And so far, this brand has been able to avoid a lot of that. Certainly in the public market, you can see the conversions that they've done with Zoe's, and even their own organic new store growth has outpaced or at least the expectations we've had so far. But I think, the learnings that they can take is you got to continue to reinvest back into the experience. You can't make bad real estate decisions. You got to consistently invest back in the people and technology in order to make this work and keep the operation simple. When you start going off the rails in terms of, new products, new ventures that don't necessarily fit to the core brand and what the consumer is actually looking for, while it might temporarily drive some sales, it could ultimately provide some headaches for the operators at the stores over time. And I think they've done a really nice job early on, avoiding any sort of misstep.
John, great to have you on the show today. Thanks so much for your time and insight.
Yeah, thank you. I appreciate it.
Investors are in a holding pattern as they wait for the January PCE data on Thursday, but the recent run up to record highs as another bank raising its target on the S&P 500. Josh Schaefer is here with the very latest. Josh.
Yeah, Josh. So Barclays is coming out today and moving up their price target for the S&P 500 from 4,800 to 5,300. But we've found another part of their note potentially even more interesting, and they're sort of hinting in that note that the bull case, and their bull case is 6,050 for the S&P 500, is looking more attractive. And now we should note when analysts say that, that is not their official projection. They're not saying the bull case is what is going to happen, but they're saying when you just look at the dynamics right now, the key drivers of their bull case are big tech earnings continuing to outperform, which at this point, it would be hard to really say, at least broad stroke, why that might not happen. It's continued to happen, and that's the projections right now are for it to continue to happen. And then the other part of that sort of ties into it is the resilient economy that we've seen. So if we continue to see strong economic growth, then other parts of the S&P 500 might also start doing better. We see earnings rebound. So if you have earnings rebound in the other, or call it 493, even though I'm not sure we're really still saying Mag 7. If you have the other 493 start to rebound and the Mag 7 keep doing well, that would be considered a bull case, very good backdrop for stocks.
So 6,050. Have we seen any other numbers like that, even in the sort of bull case? Because I know you've been going through a lot of these increases.
Yeah, the bull case, there are a lot of people that are talking about something like 6,000, maybe not necessarily in 2024, but in coming years relatively soon. So there's an interesting one I found, guys, out of Capital Economics, and they said they think that the S&P 500 could hit 6,500 by the end of next year. And what's interesting in Capital's call is they're sort of highlighting the previous tech bubble. And they're saying, well, let's assume we are in a bubble. And if we were in a bubble right now, and you go back and look at the valuations from the 2000s tech bubble, we're not even close. Like, everyone wants to call this a bubble. We're not close to a bubble in terms of valuations yet. So if you want to view this as a bubble, the stocks would go up significantly higher before that bubble actually bursts, which is sort of interesting when you think about the Capital call, because, okay, if the bubble's going to blow up to 65,000, what happens if it pops is sort of what I was left thinking, and I don't think we quite have that answer. But I thought that was interesting, that essentially if we are in some sort of AI tech bubble, maybe we continue to just balloon out a little bit more.
Inflate. Yeah.
Inflate. Still the word of the day, always, inflation. I like
Josh,
that.
thank you. Appreciate it. Coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
There we have the closing bell on Wall Street. So let's do a check of the markets here, see where things ended up since we had a mixed picture throughout a lot of the day, and that persisted through the closing bell indeed. The Dow down by almost 97 points, about 0.25%, but the S&P and the Nasdaq holding up better. The S&P up almost a fifth here, the Nasdaq up almost 0.4%. As I mentioned earlier, utilities, communication services coming back today. Energy, however, was a bit of a drag.
The market's closing the day mixed. Jared Blickery is back with a look at the day's action. Jared.
That's right. Dow down, but small caps leading up 1.4%. Not a whole lot going on with the S&P 500 and the Nasdaq Composite. By the way, the Nasdaq Composite just barely missed a closing record high by a few points yet again. It's been hovering around that level for several days now. You will see a headline sometime probably. But for today, utilities taking the cake up 1.88%. And then as Julie said, communication services also leading today up 0.8%. Materials, discretionary, financials. No tech in there. Tech is positive, up about 11 basis points, but it was healthcare and energy that led to the downside today. And despite the fact that we don't have tech really outperforming today, we do have a couple of records. Meta up 1%. That's good for a record high. Technically, it is in the communication services bucket, so that actually was a leader today. Apple up 0.8%, but we're seeing NVIDIA did manage to close at a record high yesterday, did not today. Microsoft just barely trading even there. And let's go to our leaders and where we're going to see Bitcoin really taking the cake. And I was making the argument an hour ago that we've really seen unprofitable tech just surge recently, well, recently being this week, and we're seeing the continuation of that today. ARK is number 3 there after my 2 Bitcoin ETFs. That's a disruption trade. That's up 3%. Then XRT, that's a retail, IPOs, solar, small caps, and KWeb, which is Chinese internet ETFs. We can see that doing fairly well today, following after some outsized movements yesterday in the Chinese EV space. Li Auto up 11% here. And let's take a quick look, and this isn't going to be the closing price of Bitcoin because it doesn't close, but nevertheless, we want to get a 2-day view up 10%. 56,985, basically just 57,000. And I'm just wondering how many price alerts I'm going to get overnight in the crypto sphere. Rounding out our discussion here, let's take a look at the Dow. More red than green. Apple is a bright spot here, JP Morgan treading water, but Amazon, after it joined the Dow only yesterday, down about 2/3%. Guys?
You better turn on Do Not Disturb overnight, Jared, so you don't get all those pings. So thanks so much. Well, let's check on shares of United Health and where they closed out the day. We saw that big drop there on the screen, and the Wall Street Journal reporting the company is the subject of an antitrust probe. Reportedly, Justice Department investigators have been asking about certain relationships between the company's insurance unit and its health services arm, Optum Health, which owns physician groups. Again, that's according to the Journal. And when that story dropped, you see there the reaction, the shares dropping a little more than 2%.
Yeah, it's interesting. It looks like, Julie, it doesn't look like United Health Group is commenting right now. It doesn't look like the Justice Department is commenting either, but as the Journal kind of notes, maybe more broadly, we know the Biden administration has kind of signaled the healthcare industry is a priority in its antitrust efforts. And of course, we know those efforts have certainly ramped up.
Yeah, Optum is, first of all, United Health is the largest health insurer in the United States. And Optum is a huge part of its growth strategy and has been that health services arm. It owns physician groups, and it's really grown through acquisitions as well of those physician groups. So it's interesting here. This is, to my knowledge, not an area that the Justice Department has looked into before, and perhaps because United Health has been making these acquisitions over time and now has reached a critical mass that has drawn the attention of the Health Department. It's not as though it made a big acquisition and was looking at it as a result of that. So, we'll see if there's anything that comes out of this. 90,000 physicians is the number that works just for that Optum arm.
It's tremendous.
Yeah.
The executives apparently have said in the past, I guess, Julie, that Optum and United Healthcare don't, in fact, favor one another. So, but we'll wait and see what officially how the company responds to this one. As earnings season begins to wind down, all the focus has been surrounding big tech and AI, but what other areas can investors be turning to that maybe aren't getting as much love as the Magnificent Seven? For more, we welcome in Kara Murphy, Kestra Investment Management CIO. Kara, it is good to see you. So listen, we know there's been a ton of excitement and interest in AI, but you argue there are parts of the market beyond AI that are still compelling here?
Absolutely. The type of market that we have had more recently, where there are just a handful of names doing really well, particularly those tied to AI, actually creates an opportunity. It's a tough market for stock pickers, right? Because you only have a couple of opportunities to get it right. But what that means, when you have so much attention and so many dollars chasing this one relatively narrow theme, it means that there are huge swaths of the market that nobody's really paying attention to. And so there are a lot of opportunities in there that have been able to grow in time. And so, when you think about the mega tech, as you step down in market cap from there, that's where you start to see a lot of those opportunities. And one of the most stark opportunities that comes when you do that exercise is small caps. So you have small caps relative to large caps that have had one of the widest, years of underperformance. And then when you compare valuations, typically small caps trade at like a 40% discount to large caps. They're currently trading at half the valuation of what large caps have. So you have this really massive valuation differential, so that even if small caps do indeed have greater headwinds relative to their larger peers, a lot of that is already reflected in the valuation. So anytime you get out of those really richly valued areas of the market, those opportunities start to percolate up.
Kara, those opportunities may well exist, but they don't pay off until those stocks go up, right? Valuation, something being cheap alone is not a reason for it to then rally. So when do we see a pivot? I mean, if everybody just keeps paying attention to tech, and doesn't pay attention to small caps, so what's going to sort of give in this market? What's going to change?
Yeah, it's a great question, because you're absolutely right. Valuation is a terrible timing tool. It's a pretty good predictor of what returns will be over the medium to long term. But that does not suggest that, for instance, small caps are suddenly going to start to outperform relative to large caps. But, I'm in the business of building portfolios to help people reach their financial goals. So we're not building for a market for tomorrow. We're looking to, expose ourselves to opportunities that help us get to those goals. So what that means is that this is probably not the time to be leaning into these really rich areas of the market. It's a time to examine your portfolio, make sure that you have exposure to some of these other areas. You don't want to short these names necessarily, but you don't want to go whole hog into them.
And Kara, another theme you mentioned is you think investors right now would be smart to focus on quality names. What do you mean by that, Kara? How do you define quality as an investor?
Well, so we can do it in a number of different ways. And again, one obvious area to look at is high yield versus high grade corporates in the fixed income side. So high yield is a good example. These are companies who, need to pay a lot in terms of debt in order to keep managing their business. They've been able to manage through this high interest rate environment by shortening the duration of their debt, kind of hoping that interest rates are going to come down, so that then they can re-up in a lower interest rate environment. Well, now we've had Fed interest rates start to be pushed out again. But then when you look at spreads in that space, high yield spreads have actually declined despite this more difficult operating environment. So we think that's a good opportunity to be able to trade up in quality, move out of some of those high yield names into higher grade corporates, on the idea that, the Fed is maybe not going to be cutting as aggressively as what we had hoped earlier this year.
And what are the sort of other types of opportunities you're seeing as a result of pushing out those Fed rate cut expectations?
So I think in some other sectors, we see things like energy that have been unloved. We think some areas of the consumer are actually pretty attractive. And then again, in the equity side, if you start to look for companies that have higher quality balance sheets, more steady earnings, there too, I think the market has underpriced those opportunities.
Kara, switching gears a bit, I want to ask, we are staring down the barrel here of another potential government shutdown, Kara. I'm just interested as an investor, how are you thinking about that, Kara? Or are you not thinking about it? Does it sound like just kind of noise to you at this point?
So it is important. So what we've seen are a lot of different opportunities, a lot of different occasions over the last bunch of decades where we've come very close to a government shutdown or have actually had a government shutdown. Often during those instances, we've seen some market volatility heading into it, but then fairly quickly the market will recover. So what that tells us is that from a sort of medium-term fundamental perspective, these shutdowns don't really have that much of an impact on the broad market. Now, that said, every time we go through it, the credibility of the US government gets dinged a little bit. And that in turn makes it a little bit more expensive for us to raise debt, hurts treasury yields. And so it does over time kind of build up, but we would argue that, on any one given occasion, it's not going to have a lasting impact on the price of the S&P, for instance.
Kara, thank you so much. Appreciate it.
Thank you.
Still to come, according to a recent survey, millennial and Gen Z investors make their biggest moves on earnings news. We're going to dive more into those numbers with Apex FinTech Solutions CEO Bill Capuzzi on the other side. A new survey reporting that Gen Z and millennials are having FOMO when it comes to investing, especially around earnings. But Gen X and baby boomers are a little more conservative when it comes to investing. Here to help us break down the data, the CEO of the company that did the survey, Bill Capuzzi of Apex FinTech Solutions. Hey, Bill, there's always a lot of talk about the sort of generational differences, but a couple things did strike me in this. And one of them, it seems to be that you found that younger investors, they trade a lot around earnings, but not just before. They also, it seems like, sort of chase momentum upward. Is that accurate to say?
Yeah, I think before we get into the specifics, at a broad level, we have about 25 million end investors that are on our platform. And typically, or the predominant percentage of them are young investors. Roughly 70% are under the age of 40. And exactly what you just said, which is really interesting, the statistics, especially around the earnings seasons this year, this past quarter, we saw quite a bit of activity by the Gen Z, you're talking 26 and younger, and the millennials, which are 40 and younger, trading into the earnings, and then a lot of activity in and around or after the earnings.
And Bill, I'm just interested, you called out certain names in particular. Meta was interesting, for example. Talk about that one.
Yeah, it's really interesting. I looked at that, and you look at the data, coming into the earnings. Let's just focus on Gen Z, young investors, 26. When I look at the data in terms of the pattern, those 26 and younger year olds, there was a bit of fear of missing out, right? The great earnings and the amount of activity in that name was significant compared to something like Uber, which also posted really good earnings. And what it tells me is, you have this younger generation, this sort of notion, Peter Lynch, which is, invest in what you know, invest in what you use. In this case, they have this younger generation is sort of leaning into the things that they use today, number one. And number two, think that there's opportunity for that stock to continue to run.
And so when I saw this report and was reading it this morning, it made me wonder if the idea, that old saw of sell the news, is still in effect. If you look at the younger investors, the sort of the swing vote in the market, so to speak, I wonder if that sell the news effect will diminish.
Well, let's just take NVIDIA. Let's talk about NVIDIA for a second. First of all, the amount of activity is probably not too unusual. But the amount of overall activity, especially in this younger cohort of these 25 million end investors that we support today, was about double the activity today versus where it was a year ago. Probably not too crazy, given the fact that there's been a lot of activity and a lot of news on NVIDIA. The second part, I think, especially in that younger generation, the buys versus sells was about 2-to-1 ratio. So you had young folks buying pre-earnings into the earnings the day of last week, and then still continuing to buy after the earnings. So again, I think that the amazing part today is the environment that we've created as an industry has allowed for these young investors to get access to information and insight as to what's happening within these companies. And rewind the tape 10 years, 20 years ago, that same access, first of all, you couldn't open an account without the likes of an Apex, right, with $100, $200 in the account. And then the second part is all the access to information allow people to actually make good, prudent investment decisions.
And Bill, we're talking a lot about younger investors, but what about relatively older investors on your platform? Bill, I'm just interested in the kind of themes you're seeing there in terms of activity, engagement, the names and themes they're interested in.
Yeah, I'd say a couple things. Number one, there's not as much of a pronounced, let's just talk earnings season, right? We're at the tail end of earnings season. This is probably not too surprising. We didn't see a lot of pop in activity in the baby boomers. We saw some in Gen X, right? So we're talking the 43 to 50 something year olds, and then the baby boomers older. We saw activity, but not nearly as much activity in and around the earnings as we did in the younger cohort. The one exception, which was really interesting, was NVIDIA. The second largest sort of cohort that the volume was up was the baby boomers. So you had Gen Z on one side, and you had the baby boomers on the other, were the two largest sort of increase in volume over the course of that sort of 2 or 3 days where NVIDIA reported earnings last week.
Bill, thanks so much for joining the show today. Really interesting insight. Appreciate it.
Good to see you both. Thanks so much.
Consumer Reports out with its 2024 brand report card auto rankings. We're going to take a look at some of the winners and losers on the other side.
Back-to-back wins for BMW. Consumer Reports naming the automaker its top overall pick in the 2024 Brand Report car rankings. With more on other winners and losers and what was so great about BMW for that matter, let's bring in Prosper Mani. So BMW, what is it doing right and what are some of the others as well?
You know, I shared this story amongst some friends of mine in the industry and everyone's surprised. BMW, what? They can't believe that they are on top, but this is 2 years in a row. And you look at the categories that Consumer Reports, you know, like we said, they buy every car. They don't get any freebies. They test everything, and they're looking at things like road test scores, predicted reliability, customer satisfaction, safety, and BMW. The new BMWs are really killing it right now in those categories, and actually customers are happy. They're not having to go into their service centers to get them fixed. So
why were people surprised?
I think the stereotype of BMW is that it's a very nice luxury car, but they break down a lot. They're really high maintenance because they're so high strung, right? They require a lot of babying. And I think that's the you can see the comments in the article. Mine was always in the shop for 3 months and I have it for 1 month and back in the shop. So that's the reputation that sort of overhangs the brand. But clearly right now it's changing, you know. And just really quick, the other top 5 are going to be Subaru, which is not surprising, Porsche, which also surprised me, but those cars tend to make their owners happy, Honda and Lexus, which is not surprising.
Yeah.
So those are the makes and models that made the top 10 car list, Praz?
The makes of the brand report card, yeah.
Okay.
Yeah.
And I was asking you this off camera, but I'm just curious myself. There's any kind of correlation, do you think, between this report, because it is, as you said, it is very well respected. People look at it. I'm just curious, like any kind of correlation between this and like, okay, actual sales.
I haven't seen any data, but I have to agree that there has to be a lift on the sales point of view with these cars or these brands noted on these lists, because CR is so highly respected and people see that as the Bible for not just cars but dishwashers and everything else that they review. So I think there has to be a little bit of a lift there based on these numbers.
All right. So bottom line, which makes and models made the top 10 car list?
So overall, they do a category-based top 10 list: best SUV, best small car, best pickup, etc. And one of the big takeaways this year was that 6 out of the 10 were hybrids. 1 was a pure EV, the Tesla Model Y. The other 3 were regular gas-powered cars. And the big takeaway, I talked to one of their analysts there, and he told me about how the hybrids and like cars like the Camry hybrid, the Prius hybrid, the Maverick hybrid, they actually perform better than their equivalent gas-powered cars. They're smoother, more power. They're not as noisy and inefficient as the old hybrids of the past, right? We associate them with kind of like econo boxes that were not very fun. These hybrids actually have performance. They drive better, they're quieter, and
Does Subaru make a hybrid?
I have to check on that, but I don't think they do.
I just was noticing it wasn't listed on the cars there, and I think of Subaru as such a, like, for lack of a better word, sort of a granola-y kind of car, right? Yeah. So it's interesting.
They actually, I believe they don't. I got to double check that, but they have a kind of relationship with Toyota. It's like they're kind of their main overseer, and they have a Solterra, which is based on a Toyota EV, but no hybrid tech. And whereas Toyota's killing it with hybrids, right? So you think there might be some trickling there, but not yet.
Granola-y. I like
that's
that.
my adjective. Crunchy.
I like that. That's good marketing.
Vermont, Colorado, all that stuff.
Praz, thank you. Appreciate it. We move on. America's airports are getting a much-needed makeover now. The FAA has made nearly $1 billion in grants available to upgrade airports across the U.S. It's part of a broader, multi-year $5 billion initiative to improve the nation's infrastructure. Many U.S. airports are long overdue for such a maintenance overhaul. The average terminal is more than 40 years old now. So joining us now as part of Yahoo Finance's Travel Guide 2024, Industry Insights, Kevin DeGood, Center for American Progress, Director of Infrastructure Policy. So Kevin, maybe just to start big picture, why are we spending this money now, Kevin, and what kind of upgrades do you think we can expect to see here?
Well, you know, each year the FAA spends a little more than $4 billion through the Airport Improvement Program, or AIP. And these funds support really essential capital projects. This is everything from runway and taxiway construction, rehabilitation, airfield drainage improvements, lighting, signage, communications, land acquisition, really everything that airports need to grow and thrive. And these dollars are especially critical for smaller airports that aren't able to generate quite as much revenue through their operations because they don't handle as many daily flights. In addition to that, what we saw with the passage of the bipartisan infrastructure law in November of 2021, was an additional $20 billion for airports, 15 of that through formulas and another 5 through terminal modernization. And these are really record historic expenditures. And they're going to support all kinds of projects around the country that people will notice in the coming years.
Well, I should hope so, Kevin, because I have to say, if for people who are fortunate enough to, fly to another country and have seen their airports, our airports look pretty shoddy by comparison. And even in the U.S., there's a lot of unevenness in the state of terminals and the consumer experience here. So, how quickly can people expect to see some improvements, and how much of it will be stuff that they can actually see and experience?
Right. It's a great question. What we should think about is these dollars coming out of Washington are going to supplement a lot of the work, particularly that large hub airports are already doing. If we take just a little bit of a survey, LaGuardia is in the process of more than $6 billion worth of major terminal overhauls and reconstruction for terminals B and C. O'Hare is in the middle of a roughly $12 billion capital campaign. JFK has got 4 new terminals in the works. That's another $19 billion. LAX is in the process of wrapping up $15 billion worth of work, with more projects in the pipeline that are ready to be bid out in anticipation of the Olympics coming in a few years. And then Atlanta's got another $6 billion over the next 15 to 20 years as well. So we know that there's a lot of money being spent, and really these federal dollars are going to make a big contribution to that. It's sort of a shot in the arm to give even more momentum to these major capital projects. And again, a lot of that work is going to be inside of terminals. It's going to be the sorts of things that passengers notice when they show up to the airport.
And Kevin, I want to get your take too, just about all the kind of new technology that's being rolled out across the airports. Kevin, think about facial recognition tech, for example. What's your take on that?
Well, I think it's important for us to distinguish any new technology or data that's being collected potentially by one of the commercial air carriers or by the Transportation Security Administration, and the kind of data that might be collected for operational efficiencies by an airport. Airports themselves really don't have control over the choices that TSA makes. But when it comes to modern tech that airports might want to deploy to improve operations, they really have to be certain that they're working with outside providers who are, have adopted the very best strategies and practices for cybersecurity protection, as well as more broadly data governance. So one thing that airports can do is to look to the cybersecurity framework that the National Institute of Standards and Technology, NIST, which is inside of the Department of Commerce, puts together. In fact, this week, NIST released an updated cybersecurity framework that they developed over a number of years with leading practitioners in industry. So these are the very highest standards that you can have when it comes to cybersecurity protection and data governance. And what you want is, again, airports pushing their outside contractors to make sure that they've adopted those standards. But even in addition to that, what we want is airports thinking critically about what data is being collected, how is it being stored, who has access to it. You want to have strong guardrails around data resale, but you also want to have an idea on the front end before you go out and put these new systems in place. How long are you going to store this data? When are you going to delete it, right? You want to have this thought through on the front end. And I think that's something that this administration is very much aware of and working with airports to get right.
Well, we will keep track of it as we travel. Thanks so much, Kevin. Appreciate it.
Thank you. Glad to be here.
Let's get to an after-hours mover here. It is eBay. The share's rising some 4% after beating on the top and bottom line for its fourth quarter. The company raised its dividend as well by 8% and announced a $2 billion stock buyback authorization. The revenue figure up 2% to about $2.6 billion, give or take. You can see 2.56 beating estimates, earnings per share beating estimates, and the company's gross merchandise volume rose by 2% to $18.6 billion.
Yeah, eBay's interesting, Joe. I mean, it's obviously lots of competition from some big names. You think of Amazon, for example. They have been in cost-cutting mode. Remember last month they announced they were going to cut jobs. I think it amounted to around 10% of their full-time workforce. If you look at, certainly higher here in the after hours on this report, pull back that chart though, the stock is basically flat so far this year. And over the past 12 months, it's gone basically nowhere. It's down about 3%. If you look at analysts, the men and women who are paid to tell you what to do with it, they are not fans either. More than 70% even now still on the sidelines.
Even if you look at a longer term, you look at a 5-year chart of this thing, it's up about 3% in that time. I guess small comfort, it's better than PayPal has performed over that period of time. It's one-time partner, right, before PayPal got spun off. But yeah, not doing great here. In the statement here, Jamie Ione, who is the CEO, talking about that they are trying to reinvent the future of e-commerce for enthusiasts. That's sort of the tack they've taken in recent years, or last year specifically. So we'll see if that, I mean, the stock is up.
At least initially, investors like it here.
Yeah.
Coming up, we're going around the horn and checking in on some of today's top trending stories, including ticket prices being raised at Walt Disney World.
Hello and welcome to Yahoo Finance's group chat. I'm Alexandra Canal here with Brooke DePalma and Josh Schaefer. And today we're talking about price hikes because unfortunately for our wallets, we don't really need to wait for Thursday's PCE inflation data to know that the price of goods and services, it's going up. And today I've been looking at Disney with the company raising the prices of park tickets once again. Disney raised annual park passes and parking fees back in October, but now they're announcing that starting next year, a single day, single park ticket at Disney World will be going up by at least $10. So it's going to now cost $119. $100. Previously, that was $109. Now, this is on the heels of a $60 billion theme park investment from Disney. I mentioned those increases that we saw in October. Again, that was for those annual park passes. The highest priced annual pass is just below $1,500. They also, at the time, raised park hopper add-ons and parking. So now we have this single day, single ticket pass increase. Now, you might be thinking, oh, $10, not that much, but I think it's just another example of how there's a lot of pressure on the consumer, and a lot of these companies, especially a big legacy media giant like Disney, which is going through its own share of issues with streaming and linear TV declines, they're passing on some of that cost to the consumer.
I mean, I might just be admitting bad math here, but I don't know about you guys. If I look at the difference between something that's $109 and $119, and I was already willing to pay $109, I don't know how much of a deterrent that is for me, to be honest. I mean, it's never exciting as a consumer to see the price for something going up and the price for something exciting like a day pass at Disney World or Disneyland going up. But I don't know. $10 like $10 really isn't that much in the scale of like how much the pass already costs. So it feels like, from a consumer standpoint, not my favorite news in the world, but if I was planning on going, I'd probably still go. So maybe a good move by the company.
Yeah, and I think like $100 each alone with that $9, with the extra $10, $100 each alone, say a family of four, it's going to be now nearly $500. Exactly, you're going to make the trip out for the experience. You're already probably planning on going, and you know that this is going to be an accrued cost that you have to do in addition to airplanes or travel or a hotel stay. And so this is a cost that you're expecting. Of course, it doesn't help that now it's 120 almost, as opposed to maybe where it was a few years ago, which was probably around 100, I assume.
It feels like a day pass to do anything exciting with your family is just so much more expensive. I'm thinking of like sports tickets, right? There's been some great graphs out there about that recently. Like, just to do, especially Brooke just did the math on taking 4 or 5 people. It just is a $500 day now to do a lot of these
what happens
big
if you want to go
things.
multiple days?
Right.
Yeah, and that's a lot of money.
Skiing, right?
Yeah,
Skiing's
go skiing
$100 now to get a day pass in most mountains. Like, everything is just getting more expensive to try and take your family out.
Yeah, I do think Disney in particular has the pricing power, which, like both of you said, if you're a family that's already planning on going, you're planning that trip for 2025, you're not going to back out just because you see the prices go up $10. And I think Disney recognizes that. These are hardcore fans of the IP. You know, you have Disney adults, you have the family. So, you know, again, I think Disney is in a position where they can raise prices. A big question mark, though, will be at what point can they not, and where that goes from there.
Will they see traffic drop?
Well, because the people that are going to Disney might be paying more to stay in their hotel, too, from high park fees to sky-high travel prices. Room rates are expected to go up in the next year as hotels try to lure staff back after the pandemic and keep up with wage inflation. And so guests could be maybe footing this bill. Guys, we've seen wages for hotel and hospitality significantly increase. You're looking at the chart right there. That's hotel worker wages sitting at record highs. You see a significant move up to about $24 an hour. Previously, it was about $18 per hour before the pandemic there. So a significant move up there. And the Wall Street Journal sort of highlighting today in a story that if wages are going up for workers, at some point that probably gets passed on to the consumer. And it's sort of interesting because there was a little bit also getting deeper in that article talking back and forth about if consumers are willing to foot that bill and if consumers are willing to take a step down in service. And you kind of wonder, at least I thought of a little bit of a chicken and the egg here of hotels have to pay people more to try and get the right amount of staff. And then people complain that their hotel costs more and they're still not the right amount of staff and they're paying all this money. It just seems like something that I don't know post-pandemic where how many years we want to call ourselves maybe out of the reopening, but it feels like we haven't quite figured that out yet in terms of services, right? You can still go to a hotel today and they don't have enough staff and the experience isn't what it was 5 years ago. And it just doesn't seem like they've figured that out.
I've had that
certainly experienced that. I've gone to hotels where you have to opt in for them to clean your room. It's not just an automatic service. You need to call the front desk and say, I want my room cleaned today. And I'm sure that has to do with staffing. I mean, it's crazy the compensation though. Hotels collectively will pay $123 billion in compensation this year, and that's up more than 20% from 2019. So it just goes to show, you know, what happened to the industry post-COVID and how this is an industry that's really still in recovery. I mean, we're significantly ahead of the shortages that we saw in 2021, but like we were saying, we're not fully back yet.
Yeah, employment in the accommodation sector is still, I believe, down 9% compared to early 2020. So we are still seeing that pullback. And then you have to keep in mind that these workers who are going to do their jobs, who are working at these hotels, some doing multiple different jobs, like the Wall Street Journal highlighted, some, also folding towels at the pool, while also working the front desk reception. And so at what point do these workers then say, hey, we're doing way more than what we did maybe 4 years ago in the same exact role? What can I get more? And so where does that fall in the hotel industry at large?
And it's a tough job.
Yeah. I was going to say that.
I would be asking for more money too if you've sat at a hotel and we've all been behind that person in line. I mean, it's a hard thing to do, to be in customer service like that for a consistent long day 100%. And have to deal with everyone with all these expectations as the prices go up for the hotels, right?
And we've seen that across the hospitality sector in general, especially post-pandemic. Not all of these people are returning to these jobs, and that's the issue. How do you incentivize workers to come back?
Consumers could be paying more there. Consumers also could be paying more at Wendy's. Finally, we've been taking a closer look at Wendy's, which isn't exactly raising all prices, but is trying something that is sure to raise a few eyebrows and maybe some tempers too. It's called surge pricing. This is also similar to what Uber does, really taking into different factors like weather, like foot traffic, and perhaps spiking prices during these highly demanded times. And so Wendy is ultimately telling Yahoo Finance that they're making a significant investment in technology to accelerate their digital business, but they are taking into consideration these different factors like weather, foot traffic to understand pricing. So they'll ultimately use AI-enabled technology to differentiate their menu prices throughout the day based upon demand. Largely what we see, it's being mostly compared to an Uber, but they're also saying, hey, if it's hot outside, more people are going to want Frosties, and so the prices could change around those times of day.
AI.
Yeah,
AI really changing things up for us.
Yeah, but it's very interesting because you would think if this works or starts to work, that would be an AI capability that most of these restaurants could flip on, right?
Scary.
You connect the data set to the foot traffic, like Brooke said, and then when there's high foot traffic, you boost the prices a little bit. It's not like it's the old days where someone's pressing the switch, right? It is an AI-operated engine,
just flips over.
and it just happens, which is pretty wild. It will be interesting to see when the price hikes happen, right?
And
when
how significant they are, like how much more will it be?
How much more of an increase will it be?
During those popular
And they say that they're trying to offer value here, that they're going to play in. But of course, this is an opportunity for Wendy's to really increase sales, especially during day parts that they're really trying to increase demand in. So we're seeing a large amount of consumers go in for lunch, but they want more people to come in for breakfast. They want more people to come in for the afternoon and late night. And so how will this all play into that as well?
And I also think dynamic pricing, we see that across multiple industries, right?
Yeah.
Like if you want to see a matinee as opposed to a prime time show at the theater, you're going to be paying less. So, it could be something that works for Wendy's. I think it all comes down to how much more people are going to pay, and that'll be very interesting.
As a consumer, it seems brutal, though.
But will you ever know how much more you're unless you got your prices?
The 4 for $4 is $4. You know, the 4 for $4 is $4.
They would keep their
they're not going to be able to market it that way.
You just have certain things that you expect to pay a certain amount for, and I think it'll be interesting to see how consumers react to that once the price is a little different.
Will consumers avoid long drive-through lines, maybe?
I need a Baconator. I need a Baconator.
Immediately, need a Frosty, need some fries.
All right, but we're going to take a look at shares of Salesforce ticking higher after hours today. And with the company set to report earnings on Wednesday, Yahoo Finance is going beyond the ticker to take a look at some of the biggest moments from the software giant's 25-year history.
Over the past quarter of a century, Salesforce has become one of the global leaders in the cloud-based software industry. In 2022 alone, the company's revenue topped $31 billion, a more than 18% year-over-year increase. But what led to Salesforce's growth in the cloud computing industry? Beyond the Ticker takes a closer look at some of the company's biggest moments. Salesforce was founded in 1999 by former Oracle executive Mark Benioff, Parker Harris, David Melinoff, and Frank Dominguez, specializing in software as a service. But just a year later, the dot-com bubble burst, and the company was forced to lay off 20% of its employees. On February 7, 2000, Salesforce.com officially launched an event themed around the end of software at San Francisco's Regency Theater, featuring the B-52s. Salesforce continued to grow, with its revenue skyrocketing to over $100 million by December 2003. And in June 2004, the company went public via IPO on the New York Stock Exchange at $11 per share. In 2009, Salesforce's annual revenue topped out at just over $1 billion. And the same year, the company launched Service Cloud for customer service and support automation. 5 years later, Salesforce debuted Trailhead, a free online learning platform empowering anyone, regardless of education level, to develop the skills needed to land top tech jobs. 2 years later, the company launched Einstein, the first comprehensive AI technology for customer relationship management, making AI accessible to every company and business user. In 2020, Salesforce was added to the Dow Jones Industrial Average, replacing energy giant ExxonMobil. And in 2021, Salesforce completed the acquisition of Slack for $27.7 billion, its largest acquisition to date. 2 years later, the company introduced the next generation of Einstein AI, Einstein GPT, the world's first generative AI for CRM. From its humble beginnings to a market cap of over $276 billion, Salesforce now stands as one of the world's most distinguished software companies.
Paramount reporting earnings tomorrow, and this print could be pivotal for the company. The stock is down nearly 50% in the last year as its TV, movie, and streaming businesses have struggled to compete. Yahoo Finance's senior reporter, Alexandra Canal, is here with more. Allie.
Hi, yeah, Paramount, this is a big report for the company, especially as we've heard a lot of M&A chatter surrounding Paramount and its holding company, National Amusements. And in this report in particular, there's a few metrics that investors are going to be focused on. One is whether or not Paramount can see continued improvements in that direct-to-consumer streaming business. They are expected to report a DTC loss of $534 million. That's wider than the loss we saw in the third quarter, but a slight improvement on a year-over-year basis. Paramount did say in its latest report that full-year direct-to-consumer losses in 2023 will be lower than 2022, with anticipated Q4 losses similar to the year-ago period. In terms of subscribers, though, Paramount Plus is expected to add 3.8 million net additions. It currently boasts about 63 million total subscribers. And then on the TV side, we're going to continue to see a slump in linear ad revenue and licensing revenue, while free cash flow should once again be strong in the quarter due to the since concluded actors and writer strikes. Those strikes really helped boost free cash flow in that quarter. But again, guys, this all comes on the heels of the M&A chatter. We heard from CNBC earlier today. They had a report out that Warner Brothers Discovery is no longer interested in acquiring Paramount. That was one of the companies that was interested. We know Byron Allen submitted a bid. Skydance Media is in its due diligence period. So any updates on potential M&A on the call will be closely followed. But Paramount really has been looking to right-size its business. It's been looking to cut costs. They slashed 800 jobs recently. They slashed that dividend last year. So it's a critical moment for this company in the future, and we'll have to see how investors react after this report.
Yeah, definitely. They just want that M&A news. They don't care about the earnings
exactly,
at this point.
Exactly. That really is clouding a lot of the changes this business has made.
Feels like it. All right. Thanks, Allie. Appreciate it. We'll be looking forward to those numbers. Let's take a look at some of the other trending tickers after hours right now. Urban Outfitters is one of them. That stock down 6% on its fourth quarter results. The retailer missing estimates on the top and on the bottom line. The Urban Outfitters arm, that is the namesake brand, beat sales expectations, though Anthropologie and Free People net sales missed overall. Despite that, CEO Richard Hayne telling investors early spring offerings bode well for continued sales growth in the first quarter. And Bumble shares are sinking 7% in after-hours trading. The company missing estimates for fourth quarter revenue, even though the app added more paying users than projected during the period. The online dating and networking app's outlook for revenue for the first quarter also fell below estimates. Bumble also said it's going to cut 350 roles, a move it expects will incur costs upward of $20 million. The app stock has been on a pretty steady decline, down more than 80% since its IPO in 2021. On the flip side, Beyond Meat, those shares are up 91%, getting a boost after its fourth quarter revenue surprise to the upside. This even though the earnings loss was wider than analysts expected. The company's full-year revenue outlook was within analyst projections, though Beyond Meat did caution of ongoing pressure from high interest rates, inflation, and weakening demand in the plant-based meat category. One thing to note, 38% of Beyond Meat's float is shorted. So when you see a move like this, chances are a short squeeze is playing a role.
For sure. Time now for What to Watch Wednesday, February 28th. Starting off on the earnings front, Salesforce, TJX, Monster, HP, and Squarespace all reporting tomorrow. Salesforce is announcing fourth quarter results for its fiscal year after the closing bell. That stock already up over 13% to start the year, and the company also unveiling its new Einstein Copilot AI assistant today.
Moving over to the Federal Reserve, we'll get another round of Fed commentary tomorrow. Fed Presidents Raphael Bostic, John Williams, Susan Collins, they'll all be speaking in the afternoon. We potentially will get more insight on potential rate cuts and see if the later this year stance stays the same or if the narrative changes.
And taking a look at the economy, the first revision of fourth quarter GDP is out ahead of the open tomorrow morning. Economists forecasting no change from the first report, which was better than Wall Street's expectation, but a slowdown from last quarter's growth. The latest reading giving us a key look at the economy ahead of Thursday's PCE data. And Julie, what to watch tomorrow? What are you looking at?
Well, speaking of that PCE data, I'm zeroing in on the Fed speak once again, even though, it'll probably be sort of more of the same, but John Williams in particular could be interesting on the New York Fed. He is speaking at the Long Island Association Regional Economic Briefing. Some good regional Long Island's discussion there. And he has, in some recent commentaries, did say it'll be appropriate to start cutting later this year, but he says it's really about reading the data, looking for consistent signs that inflation is not only coming down, but moving towards the 2% longer run goal. Just another reminder that PCE on Thursday is going to be super important. We'll see if any of the commentary tomorrow sort of centers around inflation very specifically.
Good one to focus on. How about Salesforce?
Sure.
Q4 earnings on deck. That stock heading into this print. What a run. It is up over 80% over the past 12 months. Investors, they like the expanding profit margins. There'll be, of course, a lot of talk. We know about the company's AI products and tools, of course, from Mr. Mark Benioff. Team at Jefferies with a preview for their clients. They rate this one a buy, by the way. Say their survey work indicates modest improvement in demand, manufacturing and tech verticals rebounding, public sector strong, they say. I think you will hear Mark Benioff guide conservatively for 2025.
You know what's interesting, too? He had come under some criticism, right? He had been the subject of activists who were pushing him to perhaps not expand as much as he had been. And it seems like he's been redeemed a little bit. The investors feel like he's starting to get back on the right track with the company.
Always one of the better conference calls to listen to. Benioff always just brings the energy.
Yeah. He's that kind of guy.
For sure.
All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.